GDP growth was 4.8% for the Jan to March quarter. It is not a number that we are satisfied with. We have to continue persevering on increasing the growth rate, and we intend to do so. And over time, the measures that have already been taken will also start kicking in, which will increase the rate of growth. There are some silver linings, however, in the news that was announced on Friday. One aspect is, of course, the fiscal deficit, which came in at 4.9%, which you must remember is something which involves a tremendous amount of effort in bringing it down from what at one point was anticipated to be 6.1 in most analysts' forecasts. To bring it down to 4.9 is a substantial reduction in the size of the fiscal deficit, and that will help put the government's fiscal path in order and help assuage external concerns. Equally important is to remember that that involves a substantial compression of government demand. The fact that you've got 5% growth with that substantial compression in government demand, if you look at the aspect of services which typically relates to government demand, that has come down substantially, and that suggests we've got this growth without the crutch of government demand. So that's on the positive side, and to the extent that government spending can resume more quickly. Remember, there's a tremendous compression of government spending in the last quarter of fiscal 12-13. To the extent we can start government spending of the budgeted amounts this year earlier, we can get some growth that way. Second point to note in the GDP growth numbers was that agriculture played a very small part. In fact, agricultural growth was very low. The fact that the Rabi crop has been quite healthy, and it will start coming in a bigger way in the first quarter of the new fiscal, will help growth also. Finally, if you look at finance, insurance, real estate, and business services, that grew quite strongly, and that will be a support to growth. Now, in terms of what needs to be done more, clearly we cannot rest. There is much more that needs to be done. The CCI has been working, the Cabinet Committee on Investment has been working, clearing projects. Approximately 25 billion, 27 billion of projects have been cleared, $1 billion of projects have been cleared, which is about 1.4% of GDP. We need to do more, of course. There are still a number of projects that need to be accelerated, and here the committee of secretaries that was set up to help this process will help. In addition, over the next few weeks, we hope we will be able to announce measures on coal pricing that will help clear some of the log jams in the power sector, and that will also help growth. In terms of other sort of macroeconomic variables, the inflation numbers have been coming in quite low. WPI inflation, as you know, is 4.89%. But the interesting number that has started falling is CPI inflation. CPI industrial worker is now on a month-to-month basis. If you look at the non-food portion, it's trending towards zero. That's very important information, because if that persists, and if we can bring food inflation down, that will allow the monetary transmission mechanism to work a lot better than it's working so far. If you look at interest rates, the RBI has cut interest rates by 125 basis points since January 1st, but commercial banks, just take an example, SBI, haven't been able to cut even a fraction of that number, a significant fraction of that number. SBI, by some measures, has cut about 30 basis points since January 1st. Now, why hasn't SBI cut? In part because their cost of funding is high, and they haven't been able to pass through the interest rate cuts. Now, why haven't they been able to reduce their cost of funding? Because if they cut deposit rates too much, they won't get deposit growth. Deposit growth is already too slow. So one of the things that we hope is that as inflation, CPI inflation comes down, depositors will feel comfortable with existing interest rates or even somewhat lower interest rates, and will be willing to accept those lower interest rates with the promise that interest rates are going to go down further over time. And therefore, you'll get deposit growth even with lower interest rates. The commercial banks can therefore cut deposit rates and pass through deposit rate cuts into lower lending rates. That will help growth in many ways. Industries, it will help give them lower cost of finance, but also retail investors will give them lower EMIs, and they can buy more.